You know what's fascinating? For months, we've been watching this slow-motion train wreck unfold in the precious metals market. Everyone's been talking about it. The data's been screaming it. But the price? The price has been doing its own thing, completely disconnected from reality, until now. Because something fundamental just shifted. And I'm not talking about some minor technical breakout or a temporary squeeze. I'm talking about a structural change in the market that's been building for years, and it's finally starting to show up where it matters most, in the price you see when you check your portfolio. Let me paint you a picture of what's actually happening right now, because the mainstream financial media isn't telling you the full story. They're giving you the surface-level narrative, but they're missing the deeper currents that are about to reshape the entire precious metals landscape. Silver mine production has been declining, not just this year, not just last year. We're talking about a multi-year trend that's accelerating. The easy silver has been mined, the high-grade deposits are depleting. And here's the kicker. The cost to extract what's left keeps climbing while the ore grades keep falling. It's basic geology meeting basic economics, and the result is inevitable. But here's where it gets really interesting. While supply is contracting, demand is exploding from directions most people aren't even watching. Sure, everyone knows about the investment demand. Everyone's heard about the industrial applications. But do you understand the magnitude of what's coming? The solar industry alone is projected to consume massive quantities of silver over the next decade. Every solar panel requires silver for its photovoltaic cells. There's no substitute that works as efficiently. And as the world races toward renewable energy targets, that demand isn't optional. It's structural. It's baked into government policies across dozens of countries. It's funded by trillions in infrastructure spending, and it's not going away. Then you've got the electronics sector. 5G infrastructure, electric vehicles, advanced computing, medical devices. Every single one of these growth industries requires silver. Not wants it, requires it. Because silver has unique properties, the highest electrical conductivity of any metal, the highest thermal conductivity, the most reflective. You can't just swap it out for something cheaper when these properties matter. Now, let's talk about what happened in the past when supply and demand got this far out of balance. Because history doesn't repeat, but it sure does rhyme. Go back to the late 70s. Silver was trading around $5 an ounce in the mid-70s. Industrial demand was growing. Mine supply was relatively flat. The Hunt brothers saw this setup and started accumulating. But here's what most people miss. They weren't wrong about the fundamentals. They were actually right. The supply-demand imbalance was real. What got them in trouble was the leverage and the regulatory response. But the underlying thesis? Spot on. And silver went from $5 to $50 in just a few years. I'm not saying we're going to see that exact scenario play out again. The market structure is different now. The players are different. But the fundamental principle remains the same. When you have declining supply meeting rising demand, something has to give. And what gives is the price. Fast forward to the early 2000s. Silver was trading in the $4 to $5 range. Mine production had been declining for years. Industrial demand was picking up as technology advanced. And what happened? Silver went from under $5 in the early 2000s to nearly $50 by early 2011. That's a tenfold increase driven primarily by the same supply-demand dynamics we're seeing set up right now. But here's what makes the current situation even more compelling. Back then, investment demand was a relatively small part of the equation. Today, investment demand has become a massive force in the market. Exchange-traded funds hold hundreds of millions of ounces. Central banks are diversifying reserves. Institutional investors are allocating to precious metals as an inflation hedge and a portfolio diversifier. And speaking of central banks, let's talk about what they're doing right now, because their behavior tells you everything you need to know about where this is headed. Central banks have been net buyers of gold for over a decade now, but the pace has accelerated dramatically. We're seeing record purchases quarter after quarter. The People's Bank of China, the Reserve Bank of India, central banks across Asia, the Middle East, Eastern Europe. They're accumulating at a pace we haven't seen since the early 70s, right before the last major monetary reset. Why? Because they see what's coming. They understand that the current monetary system is under stress. They're watching the debt levels. They're watching the currency debasement. They're watching the geopolitical realignment. And they're positioning accordingly. The BRICS nations aren't just talking about alternatives to the dollar anymore. They're building the infrastructure. They're settling trade in local currencies. They're discussing commodity-backed settlement systems. And at the center of all these discussions? Gold and silver. Physical, tangible assets that can't be printed, can't be debased, can't be frozen by a foreign government. Now here's where this connects to the supply shock we're seeing play out in real time. The paper market for precious metals, the futures contracts, the derivatives, the unallocated accounts, has been the tail wagging the dog for decades. The price discovery mechanism has been dominated by paper trading that's completely disconnected from physical supply and demand. You could have 1,000 ounces of paper claims for every ounce of physical metal, and as long as everyone's content to trade paper, the system works. But what happens when people start asking for physical delivery? What happens when the industrial users need actual metal for production? What happens when investors decide they want the real thing in their possession instead of a promise on a screen? You get a squeeze. And not just any squeeze, a structural squeeze that can't be resolved by printing more contracts or adjusting margin requirements. Because you can't print physical metal. You can't create it out of thin air. You either have it or you don't. We're starting to see the early signs of this playing out. Premiums for physical metal over spot price have been elevated for months. Delivery delays are becoming more common. Refineries are running at capacity. The spread between paper prices and physical prices is widening. And here's the thing that should really get your attention. The commercial traders, the big banks and institutions that have traditionally been short precious metals, they're changing their positioning. The commitment of traders' reports show a dramatic shift. These aren't retail investors or gold bugs. These are sophisticated players with access to information and analysis that most people never see. And they're repositioning for higher prices. Let me give you a specific example of how this supply shock is manifesting in ways most people aren't tracking. There's a major silver mine in South America that's been producing for decades, high-grade deposit, reliable output, one of the top 10 producers globally. Last year, they announced they're hitting the end of the economically viable ore body. Production is going to decline by more than half over the next 3 years. Then the mine closes. That's millions of ounces coming off the market, permanently. Now you might think, okay, they'll just open a new mine to replace it. Except it doesn't work that way. It takes 7 to 10 years to bring a new mine online from discovery to production. You need to find the deposit, prove the reserves, get the permits, secure the financing, build the infrastructure. And that's if everything goes smoothly, which it rarely does. So you've got supply coming off the market now, and even if someone started developing a replacement mine today, it wouldn't produce an ounce for close to a decade. Meanwhile, demand keeps growing. Every year. Compounding. This is happening across the industry. Mines are depleting. Ore grades are declining. New discoveries are rare and getting rarer. The easy deposits have been found. What's left is deeper, lower grade, more expensive to extract, and often in jurisdictions with political risk or regulatory challenges. And here's where it gets even more interesting from an investment perspective. The mining companies themselves are undervalued relative to the metal prices. The sector has been out of favor for years. Capital has flowed elsewhere. The valuations are compressed. But as this supply shock drives prices higher, the leverage in the mining stocks is going to be enormous. A 20% move in the metal price can translate to a 50 or 100% move in the right mining stocks. That's the nature of operational leverage when you're a producer. But I want to bring this back to something more personal, more immediate for most people watching this, because this isn't just about trading or speculation. This is about wealth preservation in an environment where traditional safe havens are looking increasingly unsafe. Think about what's happened to the purchasing power of currency over the past few years. Inflation has been running hot. Real inflation, not the manipulated official numbers, but what you actually pay for food, energy, housing, healthcare. Your dollars buy less, your savings are being eroded, and the central bank's response? Print more money, keep rates artificially low, inflate away the debt. This is why people are moving into hard assets. This is why precious metals are seeing renewed interest not just from traders, but from regular people who are trying to protect what they've worked their whole lives to build. Quick aside here, if you're sitting on a significant amount in retirement accounts, there are ways to get physical precious metals into those accounts without triggering tax penalties. I put together a free guide on how this works. It's in the description. Covers the mechanics, the rules, the considerations. Worth checking out if that's relevant to your situation. Anyway, back to this supply shock and where prices are headed next. The technical picture is confirming what the fundamentals are telling us. We're breaking through resistance levels that have held for months. Volume is increasing on the upside moves. The momentum indicators are turning positive. And most importantly, the price action is starting to reflect the underlying supply-demand reality. But here's what I think most people are missing about the magnitude of the move that's potentially ahead of us. When supply-demand imbalances reach a critical point in commodity markets, the price moves aren't linear, they're exponential. Because the market has to ration the available supply through price. If there's not enough to go around at current prices, the price has to rise until demand is destroyed or new supply is incentivized. And in the case of precious metals, where supply is relatively inelastic in the short to medium term, that means prices can move much further and faster than most people expect. We saw this in oil in the mid-2000s. We saw it in copper during the China infrastructure boom. We saw it in uranium when the nuclear renaissance narrative took hold. And we're setting up to see it in precious metals as this supply shock fully manifests. The smart money is already positioning. The central banks are accumulating, the industrial users are securing long-term supply contracts, the institutional investors are allocating. And the retail investors? Most of them are still sitting on the sidelines waiting for confirmation, waiting for the mainstream media to tell them it's safe to buy, by which point, of course, the easy money has already been made. Let me give you another historical parallel that I think is particularly relevant right now. In the early 2000s, there was a metal called palladium. It's used primarily in catalytic converters for automobiles. Supply was tight, demand was growing, and the price was relatively stable around $200 an ounce. Then the supply-demand imbalance became acute. Russia, which was a major supplier, reduced exports. Auto production was ramping up globally, and palladium went from $200 to over $1,000 in just a couple of years. But here's the interesting part. Even after that massive move, the fundamentals remained strong. The supply-demand imbalance persisted, and palladium eventually went on to trade above $3,000 an ounce. The initial move wasn't the end of the story. It was just the beginning of a multi-year bull market driven by structural supply constraints meeting inelastic demand. I'm not saying precious metals are going to follow the exact same path. Every market is different. Every situation has unique characteristics, but the underlying dynamics, declining supply, rising demand, structural imbalances, those are the same, and they tend to produce similar outcomes. Now let's talk about the geopolitical dimension of this, because it's becoming increasingly important and it's something that could accelerate the supply shock in ways that are hard to predict. The world is fragmenting. The post-Cold War era of globalization and cooperation is giving way to a more multipolar, more competitive, more nationalistic world order. Countries are prioritizing resource security. They're restricting exports of strategic materials. They're building domestic supply chains. They're weaponizing access to critical commodities. Precious metals sit right at the intersection of this trend. They're monetary metals with thousands of years of history as stores of value. They're industrial metals critical for modern technology. They're geopolitically significant because their production is concentrated in a relatively small number of countries. And they're increasingly being viewed as strategic assets that nations need to control. China has been systematically accumulating gold for years, not just through official central bank purchases, but through encouraging domestic production, restricting exports, and incentivizing private citizens to buy. Russia has been doing the same thing. These aren't random policy decisions. These are strategic moves by nations that see the writing on the wall for the current monetary system. And as this geopolitical competition intensifies, as the world becomes more fragmented, as nations prioritize resource security over free trade, the supply of precious metals available to the global market is going to shrink. Not because there's less metal in the ground, but because more of it is being held domestically, accumulated by governments, kept out of international circulation. This is another dimension of the supply shock that most analysts aren't fully accounting for. They're looking at mine production numbers and recycling rates and industrial demand. But they're not fully considering the geopolitical hoarding that's happening beneath the surface. Let me bring this to a more practical level with a specific scenario that illustrates how quickly things can change. Imagine you're a manufacturer. You use silver in your production process. You've been buying it on the spot market for years. Prices have been relatively stable. Supply has been reliable. Then suddenly your supplier tells you there's a delay. Then the delay gets longer. Then the price they're quoting is 20% higher than it was last month. Then 30% higher. Then they're asking for long-term contracts with minimum purchase commitments because they need to secure their own supply. This is starting to happen. Not everywhere, not all at once, but in pockets, in specific markets, with certain suppliers. And as the supply shock intensifies, It's going to become more widespread, more acute, more disruptive. And when manufacturers can't get the materials they need, they do one of two things. They pay whatever price is necessary to secure supply, or they shut down production. Either way, the price of the commodity goes up, because the demand is inelastic. They need it to operate, they can't just decide not to use it. This is the mechanism through which supply shocks translate into price spikes. It's not smooth, it's not gradual, it's sudden and dramatic because the market has to clear at a price where supply and demand balance, and when supply is constrained, that price can be much higher than anyone expected. Now, I want to address something that I know some people are thinking. They're looking at the current economic environment, the potential for recession, the concerns about demand destruction, the possibility of deflation, and they're wondering if that's going to offset the supply shock. It's a fair question, and the answer is nuanced. In a severe deflationary collapse, everything goes down initially. Commodities, stocks, real estate, everything except cash, and the safest government bonds. We saw this in 2008. Precious metals weren't immune. They sold off along with everything else in the initial panic. But here's what happened next. As central banks responded with unprecedented monetary stimulus, as governments launched massive fiscal programs, as the currency debasement accelerated, precious metals didn't just recover. They went on to make new highs. Because the supply-demand fundamentals reasserted themselves, and the monetary debasement provided an additional tailwind. So even if we do see a near-term economic slowdown, even if there's a deflationary scare, the structural supply shock in precious metals is still there. The declining mine production is still there. The industrial demand from secular growth trends is still there. And the monetary response to any economic weakness is going to be more stimulus, more money printing, more currency debasement, which ultimately supports precious metals prices. Let me give you one more piece of the puzzle that I think is critically important. The derivatives market for precious metals is enormous. The notional value of gold and silver derivatives dwarfs the value of the physical market. And these derivatives are used for everything from hedging to speculation to price suppression. But derivatives only work when there's confidence in the underlying system, when counterparties trust each other, when the paper promises are believed to be as good as the physical metal. What happens when that confidence erodes? What happens when people start questioning whether the paper claims are really backed by physical metal? What happens when someone demands delivery and the system can't provide it? You get a crisis, a derivatives crisis that forces a repricing of the physical metal relative to the paper claims, and that repricing could be dramatic. Because if the paper market has been suppressing prices below where they would be based on physical supply and demand, then the unwinding of that suppression could lead to a very rapid price adjustment. We've seen hints of this in the past. The London gold pool in the 60s collapsed when the demand for physical gold overwhelmed the ability of central banks to supply it at the fixed price. The Hunt brothers' silver squeeze in the late 70s exposed the fragility of the paper market when physical demand surged. The gold backwardation events in the late 2000s showed stress in the physical delivery system. Each time, the system adapted. Rules were changed, margins were adjusted, delivery mechanisms were modified, but the underlying tension between paper and physical never fully went away. It just got papered over, pushed into the future, allowed to build up again. And now, with the supply shock hitting, with physical demand surging, with geopolitical tensions rising, with central banks accumulating, we might be approaching another one of those moments where the paper market and the physical market diverge in a way that can't be ignored or managed away. This is why the price action we're seeing right now is so significant. It's not just a technical breakout. It's not just a momentum trade. It's the beginning of a repricing that reflects the underlying physical reality. The supply shock is finally hitting the price, and once this process starts, once the market begins to price in the true supply-demand dynamics, the moves can be much larger than most people expect. Think about what this means for your portfolio. Think about what this means for your wealth preservation strategy. Think about what this means in a world where currency debasement is accelerating, where geopolitical risks are rising, where traditional safe havens are looking increasingly risky. Precious metals aren't just a trade, they're insurance. They're a hedge against monetary chaos. They're a store of value that's survived every currency collapse, every financial crisis, every geopolitical upheaval in human history. And right now, with the supply shock finally manifesting in prices, they're also offering what could be a generational opportunity for those who understand what's happening and position accordingly. The data is clear. The trends are established. The fundamentals are compelling. Mine production is declining. Industrial demand is rising. Investment demand is surging. Central banks are accumulating. Geopolitical tensions are intensifying. The paper market is showing stress. And the price is starting to reflect all of this. This isn't speculation. This isn't hype. This is basic supply and demand playing out in real time in a market that's been mispriced for years. And as this repricing continues, as the supply shock fully manifests, as the physical market reasserts itself over the paper market, we could be looking at price moves that dwarf what most people think is possible. The question isn't whether the supply shock is real. The data proves it is. The question is whether you're positioned to benefit from it, or whether you're going to watch from the sidelines as one of the most significant commodity repricing events in decades plays out. Because this train is leaving the station. The supply shock is hitting the price, and the opportunity window for getting positioned at reasonable levels is closing fast.